The statistics went our way this week, which is good news for mortgage rates. Hey, it's Eric Osnes here with ericismybanker.com and CMG Home Loans with my weekly update on mortgage rates for the week ending June 14, 2024. The May Consumer Price Index, CPI, showed that inflation was up 0% for the month, cooler than expectations. The core reading, which strips out volatile food and energy prices, increased by 0.2%, which was also below expectations. Year over year, core CPI declined to 3.4% from 3.6%. Still well above the Fed's target of 2%, but at least finally starting to slowly go in the right direction. The shelter component of CPI, which makes up 45% of the overall index, moderated a bit as well, rising 0.4% for the month. Year over year, that's up about 5.7%. It's shelter and motor vehicle insurance that are still holding CPI higher than it would be. Everything else, the price increases have cooled. Also this week, the Producer Price Index, or PPI, which measures the cost of raw materials and components to manufacturers, also cooled, dropping 0.2% negative compared to expectations of being up 0.1%. And the core number fell to 2.3% from 2.4%. Lots of numbers there, I know, but this is all good news for interest rates. And finally, this week, initial jobless claims for last week went up by 13,000 to 242,000 people looking for jobs. Those are active unemployed in the last 4 weeks. That is the highest number in the last 10 months. Higher unemployment is good for mortgage rates, not good for the person that's unemployed. But that is an indication of a slowing economy, and that combined with these CPI numbers are all pointing in the direction towards lower interest rates. All of these factors help push mortgage rates below 7% for the first time in a couple of months. Here are the national averages. Conventional 30-year fixed rate, 6.99%. That's down 0.16 from a week ago. 15-year fixed rate, 6.4%. That's down 0.2. 30-year fixed rate FHA and VA loans, 6.44%, down 0.2. And 30-year fixed rate jumbo, 7.23%, down 0.14. Moving on, credit card debt. Let's talk about that. How bad is it? We know that credit card debt in the U.S. has spiraled to new heights in the last few years. In March, it surpassed $1.13 trillion and is still climbing. Many of these cards carry massively high interest rates in the high teens or even into the 20s. Are you in a situation where your primary mortgage is at a nice low rate, but your credit card balances are eating you alive? Many of our clients are in that same boat. You may be at a point where your blended rate, the rate on all of your debts combined, including your low rate mortgage, exceeds the rate that you could get by refinancing. We're seeing refinance activity increasing fairly significantly for that very reason. And as painful as it would be to lose that low interest rate on your first mortgage, if you can lower your overall cost of borrowing by consolidating your debts into one loan, it may be worth considering. Another option is a home equity line of credit, or a HELOC. It's a second mortgage that would allow you to keep your first mortgage but consolidate all those high interest debts into that second mortgage or into that HELOC. We have fixed rate HELOCs available even out to 30 years, as well as traditional HELOCs that are variable rate and tied to prime rate. Those rates will fall when the Fed starts to cut rates. Closing on a HELOC is fast, can happen as little as 5 days. So just reach out. I can run the numbers. Let's calculate your blended rate and help determine if it makes sense to consider some of these options. I'm here to help. You can call me anytime, 206-915-3742. You can email me, eric@ericismybanker.com, or look for me on social media. Just look for Eric Is My Banker and you'll find me. That's all I've got for this week. I hope you have a great weekend. Talk to you next week.